Hello and welcome to our latest Insider interview. Today in the studio I have with me Alex Wright, Fund Manager of the Fidelity Special Values Investment Trust. Alex, thanks for coming in today.
Thanks for having me.
So Alex, you're a value investor. You like to buy companies trading on cheap valuations that have good recovery potential. Could you talk us through your approach?
Yeah, that's right. So Special Values and Special Situations, the open-ended fund, they both invest in a value contrarian way, which for me means buying something that is worth more than the market is currently paying for it. And generally that means stocks that have got some kind of issue, which is making people not pay up for fair value. And then we want to look at how is this value likely to be realised over time. So that may be in a recovery in the company itself, or maybe a change in the industry where that company is operating. And that's how we build up the portfolio.
In terms of company size, you invest across the UK stock market, but with the investment trust, there is a preference for the mid and small cap parts of the market. Could you explain why?
Yeah, you're right. About 60% of Special Values is invested in mid and small cap companies, so companies below about £2 billion market cap. And the reason we do that is the UK is quite a wide investable universe of about 1,000 companies, but actually at the top end of the market, it's quite concentrated. So quite a lot of that market cap is in really quite a small number of companies, so there isn't that much choice. And if you go down the market cap spectrum, you get many more companies to choose from. It gives you a much bigger investable universe rather than focusing on the 10 or 20 biggest companies, which make up a large part of the market in terms of investable assets. So particularly when we look at PE ratios, which is a key valuation metric, you're paying about 7.5 times for the portfolio today, and that's similar between mid, small and large caps. So I think value across the market cap spectrum in the UK market today.
Could you pick out a couple of companies trading on low valuations that you think are unjustly cheap? And are there any particular sectors that stand out as well?
So we're quite diversified across sectors, and indeed we've got about 100 holdings altogether. And so we very much want the bottom-up stock picking to be the power of performance. That said, there are some areas that are bigger in the portfolio. Banks is one where we've got quite a lot of holdings, and indeed the biggest stock in the fund is a bank, Allied Irish Bank. And it's quite topical because I was out there just 2 weeks ago meeting not just AIB, but also their competitors, some of the house builders and some government agencies. And I think this is where the differentiation of the trust and our process really comes in, because while some of the UK banks have been struggling a bit this year, things are very different in Ireland, whereas AIB is still priced like a UK bank. So it's on about 6 times earnings, so cheaper than the market as a whole. But actually, if you look at what's happened to their earnings over the last year, they've roughly doubled. So an incredible performance. And that's very much because of the exit of some of the competitors in Ireland. So Ireland was already a reasonably limited banking market in terms of competition, only 5 key banks, and that's gone down to 3 in the last year. And that's really good for the returns of those who are left. And AIB has really been able to benefit from that in terms of growth in deposit accounts and also growth in margins because of the change in the interest rate environment. And I think there's a lot more to go in Ireland because of the strong economic and strong political situation that you've got there in terms of the very disadvantageous regulations that have been on the banks for a number of years post the global financial crisis are starting to loosen at the margin.
And which UK banks do you own?
So again, we're quite diversified within the UK, and so we do have holdings in some of the big UK domestic banks, so NatWest and Barclays, but also a holding in Standard Chartered, which is the biggest of the UK banks positions, but also some smaller banks, so Bank TBC, which is UK listed but operates only in Georgia, Kaspi, which is a Kazakhstani bank, which also has a London list, and then Secure Trust and Close Brothers as well, which are smaller UK banks. So I think the sector as a whole is interesting. There are clearly risks in banks, and so being diversified and playing different business models, different geographies is something we've chosen to do over the last year and has been really good for performance. Indeed, AIB's been the biggest contributor to performance, and banks as a whole are actually up over 30% over the last 12 months.
You've mentioned a couple of overseas stocks that you hold, and the trust can hold up to 20% in overseas companies. Are there any other sectors as well as banks where you have a lot of overseas exposure to?
So we tend to use that overseas exposure for sectors where there are UK analogies. So we've particularly done that historically in banks, so with AIB, also in healthcare, where we own a big position in Roche. So the geographic exposure actually of Roche is very similar to a GSK or an Astra, which are quoted in the UK. It's a global healthcare company, but we think the valuation and the balance sheet is more attractive there. And the team at Fidelity, the analyst team that we very much rely on to help us with ideas, they cover stocks on a pan-Euro basis. So again, sometimes a European quoted name will be better than the UK equivalent.
You mentioned that you're diversified across sectors. Are there any sectors you're particularly light in compared to the index?
Yeah, so the key underweight that we've got today, and indeed we've generally had since we started running the trust all the way back in 2012, is in the resources sector. So we do have some small cap mining exposure, but we don't own any of the big miners, the Anglos, the Rios, the Glencores. And that's generally been because actually metals prices have been quite buoyant for the last decade. They've generally been above replacement cost, and therefore the ROEs of those businesses have been quite high and the price to books have been quite high. So while the resources sector might look quite cheap on a PE, that's because we think that the metals are actually overvalued, particularly in iron ore and thermal coal, which would be the key metals for those big caps. And so we're very underweight that sector, having only some smaller cap exposure in mineral sands and copper.
And given that you're seeing plenty of valuation opportunities in the UK market, have you been busier this year in terms of portfolio activity? And could you name a recent example of a company that you've bought?
So I wouldn't say turnover is higher than normal. Generally, when you see sort of big movements in markets, that's when there's big turnover and where we've increased the gearing. And so today the gearing's at a more normal level, about 6 or 7%. The last time we made a lot of changes would have been in the summer of 2020 after the big COVID drawdown. And we'd done that before back in, sort of 2012 when there was the European banking crisis as well. So those very large events tend to generate big turnover. Today, we're on average, so about a 30% turnover. One of the more mid-small cap stocks that we've been buying into recently, and there's been some news flow on, is Essential. And I think this is actually typical of the sort of UK market malaise. So about 12 months ago, Essential said that they were going to split up their business, which is a conglomerate of 3 different businesses. They were looking to sell one of the businesses and list one of the others and just go back to a core events business. And the stock initially did really well on that announcement, went up about 20%. But a large amount of their shareholder base were funds that were seeing redemptions. So interestingly, over the last 12 months, the stock's gone all the way back to where it was before the announcement of this split up, despite the fact that they continued to look at this plan. So to us, that looked really interesting. There was a plan in train. It made a lot of strategic sense. You clearly looked at the valuation comps in other markets. They were much higher, and there probably were willing buyers of those assets. So that's something we started buying in the summer and has worked very quickly, where they actually announced just a couple of weeks ago that they were selling 2 of their assets, and the stock performed very strongly. And I think that is what you see a lot of stocks doing in the UK market, the fact that overseas competitors or US quoted companies or private equity companies are seeing the value and are looking to buy out UK companies on the cheap. And so we've had quite a lot of success actually with M&A across the portfolio in the last 12 months.
And finally, do you have skin in the game?
Yeah, so I invest both in the investment trust, which will be my larger holding, and also the open-ended fund special situations, which we run.
Great to hear, and thank you very much for your time, Alex.
Thank you.
That's it for this episode of our Insider interview. Please like, comment, and do hit the subscribe button. And hopefully, I'll see you again.